Welcome to today's explainer. Okay, so today we're tackling something that is honestly one of the most frustrating but also incredibly rewarding challenges in the entire financial market: conquering the markets with a small account. If you're trading with limited capital right now, the harsh reality is that the odds are just structurally stacked against you. But hey, don't worry, because today we're going to completely flip that script. We're going to set aside all those flashy high-risk strategies you see all over the internet and focus entirely on the one single thing that actually works, and that is survival over fast growth. Let's get started. I want you to really think about this for a second. Are you totally tired of depositing a few hundred or maybe a couple $1,000 only to watch it literally vanish after a few bad trades? Trust me, it's brutal, but it's also a universal beginner experience. When you're trading with limited funds, especially in super volatile markets like Bitcoin or gold, every single mistake gets magnified. Going in aggressive and constantly hunting for that one grand slam home run, it usually leads to one inevitable outcome: a blown-up account. So today we validate that frustration, and more importantly, we learn exactly how to stop the bleeding. And this brings us to the absolute core mindset shift you have to make. Seriously, if you only take one thing away from this entire explainer, let it be this: survival matters far, far more than getting rich quick. You have got to abandon that greedy, fast growth mentality. Small accounts simply do not grow through massive lucky trades. Actually, let me rephrase that. They grow through disciplined, slow compounding. I know, accepting slow, steady growth over big, fast profits is the hardest psychological hurdle you're going to face. But by focusing on just keeping your account alive through low-risk setups and tight stops, the growth will absolutely follow naturally. All right, let's dive right in. Here's our clear, step-by-step masterclass roadmap for today. First, we'll uncover the small account trap. Then we'll look at survival over fast growth. After that, we'll equip you with the golden risk rules. Fourth, we'll pinpoint the best small capital markets. And finally, we'll hand you your blueprint to consistency. Starting with Section 1, the small account trap, and the very real barriers to entry for beginners. In the US, having a small account isn't just some vague, subjective term. It's legally defined. The pattern day trader, or PDT rule, strictly limits any account under $25,000 to just 3 day trades within a rolling 5-business-day period. And wow, this is a massive hurdle. It severely limits your ability to diversify. Because you are strictly rationed on how many trades you can actually take, you are forced to become incredibly selective. You literally can't just jump into every single moving market. You have to patiently wait for only the absolute best, highest probability setups, like, say, a really clean pullback to a moving average or a perfectly formed candlestick reversal, before you even think about committing your limited capital. Moving right along to Section 2, survival over fast growth. Let's look at the brutal math of losing. The sheer cruelty of market math really boils down to this one number: 100%. Think about it. If your account takes a 50% hit from a bad, over-leveraged trade on something crazy volatile like Bitcoin, you don't just need a 50% gain to recover. No way. You brutally need a 100% gain just to get back to where you started. If you start with $2,000 and lose $1,000, that remaining $1,000 now has to literally double just for you to break even. This proves exactly why protecting your capital from early blowups is your absolute #1 job. But honestly, the math gets even worse when you look at the hidden killers out there: transaction costs and slippage. I mean, a $10 commission on a $5,000 trade, that's just a tiny blip. But that exact same $10 fee on a $500 micro account, boom, that eats up a massive 2% of your capital instantly. If you're overtrading, just jumping in and out of the market all day long, those fees are going to slowly bleed your small account completely dry before you even realize what's happening. You absolutely have to avoid overtrading at all costs. Which brings us perfectly to Section 3, the golden risk rules, and how to protect your account from early blowups. So the absolutely crucial point here is the 1 to 2% risk rule. Guys, this is totally non-negotiable. You should never, ever risk more than 1 to 2% of your total capital on any single trade, period. If you've got a $2,000 account, that means your maximum risk is just $20 to $40 per trade. Let's say you spot a really great setup on a gold chart. You must use a micro position and place a strict, super tight stop loss. If the trade goes sideways and hits that stop, hey, you only lose $20. You survive to trade another day. This is exactly why you need to focus on just 1 to 2 quality trades per day. If you want a bit more structure, you can adopt the highly effective 3-5-7 framework. It's kind of like a built-in safety net. Step 1, you cap your absolute maximum risk at 3% per trade. Step 2, you never expose more than 5% of your total account to the market at any one time across all your open trades. And Step 3, you target at least a 7% profit on your winning trades. This methodology basically guarantees that you maintain at least a 2-to-1 risk-to-reward ratio. It methodically scales your account and builds consistency, ensuring your winners mathematically outpace your losers. But hey, all these rules are completely useless without the right psychology, right? You absolutely must physically set a strict stop loss the very second you enter a trade. No mental stops allowed. You have to calculate your micro position size based entirely on that exact risk limit. You've got to fight the urge to make emotional, impulsive buys just because a chart suddenly spiked out of nowhere. And above all, please, ignore the hype and those unverified hot tips you see online. Building your confidence slowly, through real patience and avoiding greed, is quite literally the only way to succeed here. All right, on to Section 4, Best Small Capital Markets. Let's talk about where you can trade cost-efficiently. And this brilliantly illustrates the 4 clear paths you have depending on your experience level. If you're a total beginner, a demo account costs literally $0 and carries 0 risk. Now, once you actually have a solid strategy, prop firm challenges cost just a small entry fee, meaning only that fee is at risk, not your hard-earned savings. For hands-on market exposure using your own funds, micro contracts let you start with just $500 to $1,000. Finally, traditional brokerages usually require $2,000 or more, putting your full account at risk. So those are really best left for when you have some real verified experience. To get super specific here, you should really look into micro futures, where the contracts are just a tiny fraction of the standard size. Highly liquid exchange-traded funds, or ETFs, tracking the S&P 500, or Forex microlots are also fantastic because they allow for incredibly tight spreads and fractional sizing. Alternatively, prop trading firms like Ford Traders are an absolute game changer. For a fee as low as $46, you can get access to a $6,000 virtual account. This brilliantly protects your personal capital from nasty margin calls while still letting you trade real, live setups. Finally, we arrive at Section 5, your blueprint to consistency, how to pick the exact right strategy for your account size. Let's move to the data and see how this builds our case for specific strategies. Scalping, for instance, requires taking 10 to 50 trades a single day. Remember those transaction fees we literally just talked about? Yeah, scalping fees will absolutely destroy a small account. You really need at least $5,000 for that to even make sense. Day trading demands heavy screen time and at least $2,000. But look right down there at swing trading. It only requires 30 minutes to an hour a day, taking just 3 to 8 trades a week. It is incredibly cost efficient, totally avoids those annoying day trading restrictions, and is just perfect for a $1,000 account, focusing on 1 or 2 really high-quality setups. You know, a really crucial part of this whole blueprint is recognizing one simple truth. Simplicity beats complexity. Seriously, you do not need a chart that's completely cluttered with a dozen lagging indicators flashing all over the place. A straightforward trend following or swing system using clean price action, basic candles, and maybe just 1 or 2 moving averages, executed with absolute discipline that will vastly outperform a complicated, messy chart any day of the week. Pick just one strategy, master it, and execute it with total discipline. Simple strategies make it so much easier to spot low-risk setups and actually stick to your plan. So to put all of this together, here is your logical step-by-step timeline. Spend your very first month on a demo account. Test out 50 to 100 simulated trades just to prove your strategy actually works without risking a single dime. Over the next 3 months, enter a prop challenge. Prove to yourself you can hit that 9% target while strictly managing your drawdowns. Finally, by month 6, you transition to live trading and actual profit sharing. This timeline ensures you build up your confidence slowly, which for sure is the ultimate key to long-term success. Well, that brings us to the end of our deep dive into small account mastery. But before we wrap up, I really want to hear from you to help build up our community of focused learners. What capital did you start trading with? And honestly, what is your biggest struggle right now? Take a moment to reflect on your own journey, apply these survival rules we talked about today, and just keep compounding that knowledge. Thank you so much for joining me on this explainer, and I will see you next time.